Barry Brooksby, founder of Focus Wealth Group. A lot of people don't invest in what I call their number one asset, which is themselves. So great job for being here. You're investing in yourselves. This will be eye-opening and very informative. We all have to start somewhere, right? It's important to see that when we're watching or looking at successful people, what we usually see is just the top of the iceberg. Failure, in my opinion, isn't real. It's growth, it's opportunity, it's learning, and I want this to be empowering for everyone. Robert talks about it's not about the money you make, it's about the money you keep. That's one of the principles that he teaches. He also teaches about paying yourself first, that when you make money, you should pay yourself first. And another principle he teaches is assets versus liabilities. And so I have a quote here by him: invest in assets. And when we invest in assets, from his perspective, we want to invest in assets that generate cash flow. The home you live in today is not producing cash flow. It's taking cash flow. You've either paid cash for your house or you're making a mortgage payment, and so it's like a liability from that perspective. So when we think about cash flow truly, we want to think about assets that produce cash flow. So I want to just give you a couple definitions. NOI stands for net operating income. That is the annual income minus the expenses. The cap rate, or the capitalization rate, it's the ratio of net operating income to property value. Cash on cash is calculated by dividing the cash flow by the amount of out-of-pocket cash invested. We've ran that scenario before. The higher the cash on cash return, the better the investment. The higher the cap rate, the better the investment. But guess what? You still have to make sure that you cash flow. In a lot of real estate deals, there's not one rule of thumb to follow. All these analyses can take place. Now, I want to introduce you to Mark Ford. He is the co-founder of the Palm Beach Research Group. I call these the 888. And what he says is he tries to not buy property more than 8 times annual income. The other rule to consider is an 8% cap rate, and then the 8% cash on cash rate of return. The best thing you can do when it comes to real estate is educate yourself. And the more you know, the less risk you take. If you're going to spend $150,000 on real estate, where is that money sitting? This money's probably sitting in your bank account. There's a better place to put this cash, and that is a cash value insurance policy. So with a cash value insurance policy, we can be storing that same $150,000 earning 4 to 5% completely tax-free. But let's run with this a little bit further. Rather than coming out of pocket for 30 grand, what if you took a loan from your cash value policy? I'm going to do 2 things here. The first thing I'm going to do, let's make the adjustment as if there were, say, $4,000 of closing costs that we came out of pocket with too. So now your total down payment over here is $34,000, which brings your net cash on cash rate of return down to 7.71%. How do we increase the rate of return? We take a policy loan from our cash value policy. Instead of the full $34,000 coming out of your own pocket, we'll use our infinite banking plan. Our cash value policy is collateral, and use $30,000 over here as a second mortgage to increase our return. Watch what happens. When I put the $30,000 in here as a policy loan on this real estate deal, watch the 7.71% jump. That's a net cash on cash rate of return of 26% because you only came out of pocket truly with your own money, $4,000. That was it. The infinite banking concept is what you get. These are your benefits. Guaranteed money, liquid cash, protected in most states from creditors, lawsuits, bankruptcy, and tax-free use of your money. Thanks for being with me, learning how to triple your real estate returns and not take as much risk. And I hope to talk with you soon.